We'll start with our KISS portfolio construction process. We built this system to really satisfy the needs and the investment objectives of retail investors, RA investors as well. So in terms of 42 Macro, we like to keep it simple and systematic when we're making asset allocation and portfolio construction recommendations. So in terms of how this KISS portfolio construction process works, we'll start with the factor selection process. We've developed a 60-30-10 trend following strategy that is likely to materially outperform the standard 60-40 portfolio over the long term. The 42 Macro KISS portfolio construction process is a thoughtful evolution of the 60-40 portfolio framework. Our 60-30-10 trend following strategy is designed to simplify investing, minimize downside capture during bear markets, and maximize upside capture during bull markets. It does this by allocating across three asset classes: 60% in equities, 30% in fixed income, and 10% in Bitcoin. Our default equity exposure is the SPY ETF. Our default fixed income exposure is the AG ETF. And then our default Bitcoin exposure is currently the BITO ETN ETP. This is pending ETF approval, so we'll swap that out when we do see an ETF approved. So for investors that would prefer to sort of use different instruments, like let's say the Qs for this equity allocation, or TLT for the fixed income allocation, you very much could do so, and we actually provide the tools here at 42 Macro to allow you to do so, to sort of create a customized version of KISS that is more suitable to your investment objectives and risk parameters. So in terms of obviously adding an asset as volatile as Bitcoin into a traditional 60-40 style portfolio comes up with a whole host of risks. Obviously, there's a lot of reward associated with that risk, but it's our job as dutiful and systematic macro risk managers is to help, again, maximize that upside capture in bull markets across these asset classes while also minimizing that downside capture. And we do that in two ways. The first way is our top-down risk management overlay. We use our macro weather model to incorporate volatility targeting into our 60-30-10 trend following strategy. So if the weather model signal for the stock market is bullish, the target exposure for the SPY ETF is 60%. If the weather model signals for the stock market is neutral, the target exposure for the SPY ETF is 50%. And then if the weather model signal for the stock market is bearish, then we dial down the target exposure for the SPY to 40%. Similar process we do for the fixed income market. So if the weather model signal for the bond market is bullish, then the target exposure for the AG ETF is 30%. If the weather model signal for the bond market is neutral, then the target exposure is 25%. And then if the weather model signal for the bond market is bearish, then the target exposure for the AG ETF is 20%. Also do a similar process with Bitcoin. So if the weather model composite signal for Bitcoin is bullish, then the target exposure for BITO is 10%, or pending the Bitcoin ETF. If the weather model signal for the Bitcoin is neutral, then the target exposure for BITO is 7.5%, and then we dial that down to 5% if the weather model signal for Bitcoin is bearish. And so that's the top-down risk management overlay. Again, we use this to incorporate volatility targeting into our 60-30-10 strategy, because again, what the weather model signals are designed to do is to project excess return dispersion on a rolling 3-month time horizon. And so if the signal's bullish, it's saying you should expect better than normal returns in that particular asset class over the next 3 months. If the signal's neutral, you should expect similar returns. And if the signal's bearish, you should expect lower returns, higher volatility in that particular asset class. And then transitioning to our bottom-up risk management overlay, we use our volatility adjusted momentum signal to infuse dynamic position sizing into our 60-30-10 trend following strategy. So if the ETF is bullish from the perspective of our volatility adjusted momentum signal, then the actual exposure, the dynamic position sizing, will equal 100% of the target exposure, whatever the target exposure may be, according to that top-down risk management overlay. If the ETF is neutral VAMs, then the actual exposure equals 50% of the target exposure, whatever that target exposure may be at the time, again, based on that weather model signal. And then lastly, if the ETF is bearish VAMs, then the actual exposure equals 0% of the target exposure. And so obviously a lot of words on this page, but when we put this into action and have had this running live for really since January, not in this particular iteration, but we have had our KISS portfolio construction process running live since the beginning of this year, and it's obviously done quite a great job of helping investors do exactly what it's supposed to do, which is maximize upside capture in bull markets, help you, particularly when all the macro gurus out there, spewing bear porn on Twitter, spewing bear porn on podcasts. It helps the retail investor and the RA investor put earmuffs on and actually make money in financial markets when you're being, showered by bear porn as much as we tend to be as investors. In so much that when things are starting to go poorly, KISS does a phenomenal job in terms of those bottom up and top down risk management overlays of getting you out and helping you keep the money that you've made in the bull markets, which a lot of investors do very poorly, as indicated by 2022. The most recent example of that. So in terms of, these are the back tests for our KISS portfolio construction process. This is a completely out of sample back test. The bottom up and top down risk management overlay pivots are lagged by a full day in this process, which they wouldn't be in real life, but we actually do that just to, to hammer home the point that these are in fact out of sample back tests. And they're designed to simulate real world trading conditions. We definitely want to make sure that we are sitting in the same seat and our incentives are aligned with you, the retail investor, you, the RA investor, following along with KISS at home. And my incentives personally are aligned as well. Obviously, all of my liquid net worth is following this KISS portfolio construction process because, quite frankly, I think it's the best way to invest that I have access to as a retail investor myself. So in terms of the chart on the left, what we're showing here is the hypothetical performance of a $100,000 portfolio since the January 1st, 2018. As you can see, KISS in the dark blue line has a Sharpe ratio of about 0.9. That's almost double the Sharpe ratio of the 60/40 asset class, and almost double the Sharpe ratio of just being invested in 60/30/10 SPY, Ag, and BitTo on a raw basis without any of the top down and bottom up risk management overlays featured on page 5. And so in terms of what we find here is that when you're long KISS, you have this very sort of smooth, much more smooth ride in terms of building wealth and compounding wealth over time. There's only one double-digit drawdown in the entire backtest sample, out of sample backtest sample of minus 10.6%, and that occurred, sort of late, heading into the latter part of early part of this year from the peak that we observed in Jan 22. And what we found when you actually look at the 60/40 portfolio by comparison, we've seen 3 drawdowns of double digits. So there was a 12.5% drawdown in Q4 18. There was a 22.2% drawdown in COVID, and then there was another 22.2% drawdown into the lows of last year. And then when you annualize when you run that same out of sample back test process on just having the 60/30/10 portfolio on a raw basis, again without our top down and bottom up risk management overlay processes, then you've crashed 3 times in that. And so there's a minus 21.2% drawdown in Q4 18, a minus 23.3% drawdown in during COVID, and then there was a minus 25.3% drawdown kind of towards the lows of Q4 of 2022. And so when we transition to the table to the chart on the right, we show that same hypothetical performance of that $100,000 portfolio over industry standard reporting horizons. And what we find is that, on any relevant duration, KISS is demonstrably outperforming 60/40 and demonstrably outperforming not demonstrably outperforming, but outperforming the 60/30/10 raw since inception. If you look at the average annual return, again, this is since January 1st of 2018, you see the plus 12.2% average annual return in our KISS portfolio construction process. That it compares quite favorably to the 60/40 portfolio's annual average return of plus 6.6%. And then it's besting the average annual return of the 60/30/10 raw approach. And more importantly, it's besting those returns with much more favorable volatility and drawdown characteristics. As I mentioned, KISS is the max drawdown on KISS is only minus 10.6%, whereas the max drawdown on the traditional 60/40 portfolio is minus 22%, and the max drawdown on just being long 60/30/10 SPY, Ag, Bitcoin, over that same duration is minus 25.3%. And so, I'm very proud of this because obviously minus 10.6% is very manageable from the perspective of taking risk as an investor, particularly someone nearing retirement. But what's also important to keep in mind is that, when you draw down your total portfolio 20 to 25%, you are losing 20 to 25% of the years you spent working and accumulating retirement assets in your account. And so we definitely take the sort of the left tail risk portion of our investment recommendation process, our portfolio construction processes, very, very seriously. It's something we pride ourselves in helping investors chop off that left tail of the distribution. But we also pride ourselves in helping investors actually make money in financial markets, given how much macro bear porn tends to be spewed out there. So again, very proud of this process. And one final thing I'll just call out. on this slide. The reason you need to have these top-down and bottom-up risk management overlays is because markets tend to crash a decent amount. We went back and we did a statistical analysis of these three asset classes: U.S. equities, the U.S. Treasury bonds, and Bitcoin. And we looked at what we wanted to determine was the percent of time these assets were down 20% or more off their highs. And on a trailing 10-year basis, stocks are only down 20% off their highs 3% of the time. So if we've been in a raging bull market for most of the past 10 years. But when you broaden that out to as far back as we get the data, which for the U.S. equity market or the S&P starts in 1928, markets bound 20% or more off its highs 37% of the time. That's a long time. Let's say you need to retire in the next 5 to 10 years. You can afford to be down 20% off the highs during that window, which, the longer term time series suggests that's a reasonably decent probability. If you look at the bond market, it's pretty consistent. The bond market is down 20% or more off its highs 20% of the time over the last 10 years, and 25% of the time over the life of the instrument that we use to backtest. So I want to say the 25-year plus Treasury bond futures index in Bloomberg, which starts in 1977. And then lastly, for Bitcoin, those drawdown statistics are 84% and 82% in terms of trailing 10 years and an all-time, which is basically more or less the same sample for Bitcoin. So you spend a lot of time as an investor, more than 20% off the highs in these particular asset classes. And so this is why, in our opinion, it behooves you to pay attention and incorporate risk management into your investment process. You don't need to follow KISS. I personally follow KISS. We have thousands of clients all around the world following KISS, and we appreciate each and every one of them. But if you're not following KISS, it's very important that you systematize your risk management and incorporate rules, stick to those rules, and make sure those rules are driven by proven quantitative techniques like they are here at 42 Macro.